What's the best choice of structure for a small business owner? If you're a small business owner thinking about starting a small business, or maybe you've got one already and you've got questions about what exactly is the best structure to use to set up that business, well, we're going to tackle that topic on today's program. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary as well at Nelson Financial Planning, where our whole team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So before we get to all of that, of course, it is the Sunday before Thanksgiving, so we want to take a moment and wish a very happy Thanksgiving to all of our listeners out there. Be careful frying your turkeys. That's a very southern kind of thing to do, and the stats are not particularly great. It suggests that maybe people make mistakes along the way. Look this one up this morning. According to the National Fire Protection Association, annually, so every year, every Thanksgiving, frying turkeys results in 5 deaths across this country, 60 injuries, and destruction of 900 homes to the tune of about $15 million per year in property damage. So despite those stats, we will, for I think the 12th year in a row, fry a turkey at our house for Thanksgiving. We usually do 2, like one in the oven, traditional, and then that fried one. And I'll tell you, I have not really perfected that, despite it being probably the 12th time of doing it. It's either overdone, underdone. I keep talking to other folks that do it, and they're like, well, don't really do the 3 minute per pound thing, do less. And anyway, we're going to give it another shot. Hopefully we will be safe, and we encourage you to be safe as well. The reality is that it's going to cost a lot more to fry that turkey this year. We're looking at vegetable oil, the price of a gallon of vegetable oil. My goodness, it is a lot more than it was last year, combined with the fact that the turkey's probably going to be a lot more than it was last year. So I guess the cooking tip, which is not really what this show is all about, we'll get to the financial stuff here in just a second. The cooking tip would be, right, if you're frying a turkey, turn the burner off when you're putting the bird in the oil and then when you're taking the bird out, because it's that oil and that flame that doesn't really mix very well that causes, looks like a number of injuries and even deaths every year, and a lot of property damage as well. So obviously, if we're frying a turkey, that means we got some calories to burn off. So this year, which will also probably be the 12th or 13th, maybe even more, we're going to be doing the turkey trot that morning. So a great event that runs throughout downtown Orlando. If you get up early, I forget what time it starts, but the turkey trot is certainly a fun little normal Garris family tradition that we do each and every year. So anyway, we hope that your holiday is great, that you get to spend an opportunity with family, that they don't drive you too crazy this year, and ultimately wanted to talk a little bit about wishing everybody a very happy Thanksgiving this coming week. Speaking of what we have been talking about last week on the program, we talked about the increased 401k limits for the year 2022, right? $20,500 is the new limit for next year. That's up about $1,000 from the limit for this year, 2021, of $19,500. The catch-up remained the same, so that's an extra $6,500 that you could put in if you are over age 50. No change, by the way, in the IRA limit. That still remains at $6,000 with a catch-up of $1,000 if you are over the age of 50. Anyway, But those higher limits, certainly those are good numbers, but the issue is really today the lack of participation. And we're not talking about participation on the employer side. Really, it's in participation on the employee side, because if you look at participation by employers, meaning the number of employers that offer folks the opportunity to have a retirement plan available through them directly with their employer, directly out of their paycheck, that's about 68% of all private employers offer that option. Of course, that means that 32% don't, but that is very easily solved by the individual, because that's when the individual retirement account, the IRA, or maybe even the Roth IRA, comes into play as an option for that 32%. But here's the troubling number. So you got 68% of private employers offer retirement plans, make them available to their employees. Of that, only 51% of the eligible employees in that 68% group actually participate. So to translate that into a hard number, that means that about 75% of employees who have a plan through their employer are participating in that plan, meaning that they're putting money away regularly from their paycheck, saving money directly out of their paycheck directly into that plan. Oftentimes, many plans will have a match, or they're even getting some free money as a result of that. So that's great, good for the 75. The issue that we want to raise on the program is, wait a minute, there's 25% that aren't doing that at all. And so here's where we would want to take a moment and emphasize to folks that, first of all, you're probably missing out on some free money, right? If employers match, then that is money that you're leaving on the table that you're not getting, that you could easily be getting just by doing some type of match. Now, the good news is that a lot of the legislation that is floating around in Congress, and some of which is actually passed, seeks to make that enrollment in those employer plans automatic. So that will hopefully get that 25% of all employees out there that are on the sidelines, get them off of those sidelines so that they're contributing to their employer plan on a regular basis. And then as you do that, a lot of those auto contributions actually have auto escalating increases, so that every year it goes up a little bit, so you wind up automatically increasing the amount of your contributions along the way. So those are some great features. If your plan doesn't have auto enrollment, or maybe you missed it, or maybe you previously waived out of it, it's a great time here at the end of the year to lean into that and to sign up for that, because the reality is, if you sign up and do the paperwork today, it's unlikely that it's going to really hit your paycheck next time you have a paycheck, right? It always takes time to sort of process that stuff. So the reality is that you really want to try and get that all signed up so that you can start out the year with those contributions happening on a regular basis, because that's certainly an opportunity you have to try and save money for retirement. So make sure you start the year off right. Take advantage of those retirement plans that your employer is offering. If for some reason your employer doesn't offer them, well, then you would have the option of setting up an IRA or a Roth to help do that. So anyway, we're going to take a break. We come back, we're going to talk about all of those business structures that are available to a small business owner and what may be the right one for you to consider. Coming up next here on Dollars and Cents. So you're a small business owner, or maybe you're someone who wants to start a business, and there's a variety of different corporate structures that are available to you. And so in this segment of the program here on Dollars and Cents, we're going to go through sort of the four main flavors, if you will, that you have in terms of establishing a corporate structure for your business. So welcome back to Dollars and Cents. We're Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out there. Subscribe to us on your favorite podcast channel of choice, whether that's Amazon Music, iTunes, Spotify, whatever the case may be. We've got a channel on there for you. In addition, of course, to our YouTube channel where you can get to see me actually doing this program on a regular basis. To subscribe to us on those channels, just look for us under Dollars and Cents, Nelson Financial Planning, Joel Garris. Any of those names should pop up. If you still can't find us, the easiest spot to go is to our website, nelsonfinancialplanning.com, and then in the upper right hand corner you'll see a bunch of icons. Click on the one that looks most familiar to you and you will get directed to our program. My name, of course, Joel Garris, certified financial planner and certified financial fiduciary with Nelson Financial Planning. So you're a small business owner. You're trying to figure out what type of corporate entity you should be setting up. And so there's really sort of 4 different options, if you will, as a small business owner that you have. There's the sole proprietorship, there's the partnership, there's the limited liability company, the LLC, or there is an S Corp. And what's interesting about these 4 is you can actually kind of have combinations of some of these 4 as you set up your business entity. So we're going to go through each and every one of these, sort of break down sort of the pros and cons, if you will, of what each option is all about. So we'll start with that sole proprietorship. Very classic structure. A single person that has the business that is just working in it. So maybe that's some kind of consulting business or service business, or maybe you've got a product that you're selling, but it's really just you. And so with a sole proprietorship, what happens there is that it winds up being showing on your tax return, on your personal tax return, on Schedule C. So what that means is you don't have to file a separate tax return or anything like that for that particular business. It all just becomes a part of your individual tax return. So that's great. There's no separate return. That makes things easy. You don't have to do a lot of quarterly filings like 941s, UCT6s. I mean, unemployment compensation, federal withholding, all of that just sort of flows into that Schedule C. Now, here's sort of the surprises, if you will, particularly for the first-time business owner. And the biggest surprise is that if you're working for an employer, you may not realize that the employer is actually covering half of your Social Security and Medicare taxes with each paycheck. If you are a sole proprietor, then that makes you both the owner or the employer and the employee, which means that now you have to pick up both sides of those taxes. How much are those taxes? Well, 7.65% for the employee in total, and the employer matches 7.65%. So if you do the math, that means as a sole proprietor, you've got to carve out 15.3% right off the top of that profit, because that piece has got to go to pay Social Security. It's got to go to pay Medicare. Now, again, with Schedule C, you don't have some of the quarterly filings that you would typically have to do if you were paying yourself a wage or something like that, but you've still got to pay the taxes. And so when you do your taxes and ultimately you do that individual tax return, that's when that FICA tax thing sort of trues up. And because it's sort of both sides and it's something that you typically don't have to deal with on your tax return because it all just sort of happens automatically, then it surprises people, particularly in that first time. Now, wait a minute, where's this extra 15% coming that I have to pay on my tax return? Because you still got to pay the income taxes, don't forget about those. But the new piece of the equation, particularly on that sole proprietorship, and really for any of these, if you're a small business owner, the reality is that you have to now pay both sides of that. And so that can create some difficulties if you're a sole proprietorship, because maybe you're not playing with the tax forms each and every month, and so it can produce some surprises. So just be aware, yes, a sole proprietorship is going to go on Schedule C, but don't forget about Schedule SE, which is the self-employment, which then adds in that extra amount of the taxes for that. And so some people find it very hard to project, particularly on the sole proprietorship. So make sure that you're sort of running the numbers and getting an approximation of what it is that your tax liability is going to be, because there's two parts of it. There's the income tax part, and then there's there's actually three parts. The income tax part, the employee FICA, and the employer FICA. And remember, if you're sole proprietor, you're both the employee and the employer. So that's sort of the classic scenario: sole proprietor, Schedule C, single individual. The other typical option that you would have is a partnership, right? So a partnership would be more than one person, right? Sole proprietorship, sole being one, you can just have one person in the business in order to have that particular sort of corporate form or corporate structure. On a partnership, well, okay, now you've got more than one involved. And so that income or that profit is distributed based upon the percentage ownership. So if you're 50-50 partners, then you and your partner are going to sort of split that onto your tax return. That flows to your personal tax return courtesy of something called a K-1, which is the document that gets generated from that separate partnership tax return. So now, as opposed to that sole proprietorship Schedule C, all folded nicely into my individual tax return, with a partnership, now I've got a separate partnership return, Form 1065. That's the partnership return that then flows out with that. Now, the reality is that on a partnership, you still have to pay that FICA tax. So you don't get outside of that on a partnership. All a partnership is it's sort of like that sole proprietorship concept, except that it's not sole anymore. It's more than one, hence the partnership. You can have an unlimited amount of partners. It doesn't have to be two, it can be 3, 4, 5, 6, whatever the number is. The reality is, though, that you still owe the income taxes on the profit, and you still owe the self-employment tax. So you've got to really kind of make sure that you're budgeting and looking at what the numbers are. And then to the extent you're owing taxes, don't forget then that you may have to start paying in quarterly estimated tax payments along the way in order to sort of cover this additional tax liability that comes into play. And when you do those quarterly tax payments, you don't have to worry about the split between the FICA and the Medicare and Social Security and income taxes. The reality is those traditional quarterly tax payments are you putting in tax money. When you do your tax return, that's when you can sort of true it up and say, okay, well, this much went to the FICA, this much went to Medicare, this much went to Social Security, and this much went to income taxes. So that's kind of the partnership piece of the equation. So sole proprietor, one person; partnership, more than one, right? 2, 3, 4, 5. Now, LLC. An LLC is a limited liability company. That's what it stands for. And that means that you are basically opening up a company with the state of Florida, whatever state you're in. And so there's a process to go through in order to set up that LLC, where you now have to kind of set up a corporate entity. Now, the beauty of the LLC, and one of the reasons why it's as popular as it is that those companies provide that layer of liability protection, which is what everybody sort of looks for when they set up a corporate structure. But it's a simpler way to do it than a different type of, say, regular company or corporation, because particularly if it's a single member LLC, meaning one owner, so back to the sole proprietorship thing, then you can set it up as a single member LLC, which gives you that liability protection and then doesn't require a separate tax return. We're going to take a break. When we come back, we're going to continue this conversation on corporate structure, what the different options are, and sort of summarize it all up in terms of what's the best approach for small business owners to be considering. All that and more on Dollars and Cents with Joel Garris. Talking on the program this morning about the different choices that you have as a small business owner in terms of setting up that business. And we talked in the last segment a lot about sole proprietorships, how easy they are, and they become a part of your individual tax return through using Schedule C. Partnership was the other one we talked a little bit about in the prior segment. That's if you have one or more people, 2, 3, 4, 5 folks that are in business together. And then we had started the conversation about LLC, limited liability company. that is a great choice because the filing that's necessary is a little bit easier than a corporation. And the reality is that one of the things that does is, of course, is that creates a little bit of a layer of liability protection as it relates to that business that you're starting, and which is always a good thing to have, particularly to protect yourself as best as possible. The reality is that one of the things that appeals to a lot of individual business owners is that LLC, if it is a single member LLC, for tax purposes, it's treated as a disregarded entity. So what that means is then that the LLC doesn't have to file a separate tax return. It can fold very neatly into your Schedule C on your personal return. So one of the things that has the biggest appeal to that LLC is that you wind up being able to simply combine that into your personal return, particularly if it is single member. If it's a multiple member LLC, well, then it's not a disregarded entity for tax purposes. And that means then that it has to then file its own separate tax return. So if there's two or more owners of that LLC, or members as they're called in LLC language, then it's treated as a partnership for tax purposes, which means that you've got to file a partnership return, still got to pay the FICA taxes and the earnings, the self-employment taxes on that. But if it's an LLC, you can still have it if you've got more than one member, but just know that for tax purposes, it's going to look a lot like a partnership. And this is sort of where we were talking earlier in that last segment about how a lot of these concepts sort of overlap with each other. And certainly when it comes to the LLC, that's where you can kind of get some overlap in terms of, if you're a single member LLC, you can still have it as almost like a sole proprietorship and file on Schedule C on your personal tax return. So it's not a separate tax return. But if there's more than one member in that LLC, then it flips over to being viewed like a partnership. And so consequently, then you've got to file that partnership return. Now, last category, the S corporation category. And this is the one that I would say a lot, you almost have a love-hate relationship, if you will, with it. Why do we love the S Corp structure? Well, because the S Corp structure allows you to avoid some of that FICA tax on that profit. So let's say I've got a business and that business has $100,000 of income, and I decide that I'm going to just report $50,000 as my earnings, my wage, my W-2. It means that the other $50,000 passes through as income, so I still got to pay the income taxes on it, but I avoid all of that self-employment tax, that 15.3%. Well, as you might well imagine, here's the bad news on the S Corp. The IRS knows the rules, and they know that using an S Corp is an attempt to avoid the earnings tax, the FICA tax, the 15.3%. So one of the things you've got to be really careful with on an S Corp, and this is the bad news of the S Corp, is that the IRS looks at that S Corp structure and knows what you are doing. It knows that you are using that S Corp as an entity to try and avoid the FICA tax that would generally apply if you were just doing it as a sole proprietorship or a partnership or whatever the case may be, where you've got to pay the FICA tax on that. The S Corp, the goal there is to try and avoid that. And so the reality is that you can certainly use that S Corp, but you must make sure that you're paying yourself a reasonable salary. Reasonable in the IRS is going to be subject to a lot of mythical factors, right? So the things that you have to be thinking about is what's reasonable or what's not. Well, that depends on a host of factors, right? What's the industry that you're in? Is the industry that you're in really more of a industry that is purely service-based? So if it's purely service-based, then it really is self-employment earnings that you're making. It'd be hard to sort of argue that you don't owe the FICA tax on that. Meanwhile, if it was like a product you might be able to argue that some of the profit is coming from the profit margin in the product and not necessarily that the services that you are doing in that business. So you see kind of where that distinction can get pretty murky when it comes to establishing the S Corp. So folks, be careful if you're using that S Corp structure. Make sure that you at least are paying yourself some kind of a wage in order to justify that reasonable salary standard that the IRS puts on S corporations. S corporations are one of the more audited types of corporate structure, so just be careful of that. Not saying not to do it by any stretch of the imagination, because clearly there's some tax savings and you want to certainly capture that, but you need to make sure that you're doing it properly. So to summarize, Schedule C, easiest way to sort of file that business on your personal tax return. Doesn't require a separate tax return. You can still use an LLC if it's a single member, because that's a disregarded entity, so that all flows nicely on Schedule C. Again, only if you are a sole business, one person in the business. The S Corp, great option, avoids the FICA tax, but be careful there. You've really got to watch out for that W-2. So those are some of the things to be thinking about in terms of corporate structure when you're setting up a business, some of the pros and cons of all of those different types of 4 primary ways in which to do that. So that's that topic, and we certainly will shift some gears here on this segment. We want to talk a little bit about here on the program at Dollars and Cents, where we look at the growing problem that is a retiree problem that is showing a significant increase in the amount of debt that your typical retiree has. And this is, we want to spend some time on this topic here in this part of the segment, because you would think that with all of the conversation about debt and paying it off and being debt free, and you've got, you know, all the Dave Ramseys and all the articles and all of the things out there that really urge people to make sure that they get their debt paid off. And so you would imagine that, well, okay, that message is kind of resonating, or should be resonating, we hope. The problem is that that is not the case at all. The latest stats from the Federal Reserve, in 1989, less than 50% of those aged 65 to 74 had some kind of a debt. Now, again, with all that background of all the articles, all the stories, Dave Ramsey, all of that stuff that says, get rid of your debt, the opposite has happened. Here's the sad, disturbing news. For that age group, 65 to 74, today in 2019. So fast forward that 30-year period of time, we've actually seen a relatively significant increase in the percentage of that age group, that new retiree age group that still has some form of debt, an increase to 70% of that age group. So it's gone from 50% up to 70% in terms of that new retiree age group having some form of debt. That is a real problem, and we're going to talk about the problem that creates, and we're going to give you some thoughts and some suggestions on, okay, how do I maybe avoid that? Because you certainly don't want to go into retirement with a bunch of debt. So we'll talk about that coming up next here on Dollars and Cents with your host Joel Garris of Nelson Financial Planning. Talking a little bit about what has become a growing problem over the course of the past 30 years. According to the Federal Reserve, folks aged 65 to 74 in 1989, that age group in 1989, only about 50%, less than 50% actually, had debt of some kind. Fast forward 30 years to the year 2019, and now over 70% of that age group. And that 65-74 age group, that is your relatively new retiree, still struggling with debt, or a much higher percentage of them are struggling with debt. And what's surprising of all that, as we were talking about in the prior segment, is you've got all of these articles and conversations and programs and Dave Ramsey's and stuff like that that say, oh, you know, get rid of the debt, get rid of the debt. It seems to me like that message may be falling, unfortunately, on some deaf ears. So what can you do? And so we're going to talk about some of the things you can kind of attempt to do to help make sure that you're not in this growing percentage of retirees that have to deal with debt. So welcome back to the program. This is, of course, Dollars and Cents for Central Florida's longest running radio program. Also happened to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on your favorite podcast channel of choice, or if you'd like, if you're a YouTube fan, you can always go to our YouTube channel as well. Make sure you subscribe to us, because we do add some content at various times during the course of the week. One of our many of our associates will go and do videos and things like that we'll post during the course of the week. So make sure you check that out. Speaking of our other associates, we've got a team of certified financial fiduciaries at Nelson Financial Planning that are standing ready this week. Even though it's Thanksgiving, we're all in the office and stand ready to help you become in better shape for your financial future. A cost-effective financial plan that provides you with peace of mind for the future, along with superior investment results. So make sure you give us a call and ask to speak to one of the folks on the team, all of which are certified financial fiduciaries, which means that they keep your interests first and foremost in any recommendation that they make. Speaking of the recommendations, here's why we are talking about debt on the program. Debt is a real problem. It is certainly a drag when it comes to your retirement. It's an extra payment, right? You got to send out a check each and every month if you've got debt. And the interest rate obviously adds to what you owe, meaning it increases each and every month how much you actually owe on that debt, or how much effectively you're paying on the amount of money that you've borrowed. And then it generally does make you less financially secure, right? A mortgage company wants to see that payment come in each and every month. A credit card company wants to see that payment come in each and every month. And if not, the mortgage company ultimately has the ultimate recourse of kicking you out of your house. Credit card company just increases the interest rate to some exorbitant level that it makes it nearly impossible to get out from under that. So there's some real problems with having debt. So how do you solve it, right? So one of the best things to be thinking about is, as with anything, and when we understand, oftentimes folks get very overwhelmed when it comes to trying to solve financial problems, or really any problem in life. And it's important to just take it one step at a time, right? How do you eat an elephant? One bite at a time. The same thing when it comes to paying off debt or any other issue that you might encounter in life. And so I think a lot of folks get hung up on, oh, it's a big number, or I got to come up with a single amount of money that ultimately pays it off. The reality is that you really want to think about it more in terms of the number of months that you have until you retire. So think about it that way. And really, if you think of it and kind of compare it, and we'll give you sort of a general rule of thumb to use on that. Let's say you owe a certain amount of debt. You would increase that by 15, 20, 25% to sort of account for the interest, and then divide that by the number of months that you have until you reach retirement. And that'll give you a pretty good rule of thumb in terms of trying to figure out how much money do I need to pay each and every month to get rid of that debt. Now, obviously, with the internet, there's a lot more ways to finally calculate that. And if you just Google like amortization calculator or amortization schedule, that will tell you exactly what the payment needs to be to have the debt paid off within a certain period of time for a particular amount of debt and for a particular period of time. But if we just use kind of the general rule of thumb that we were talking about, let's say that you owe $150,000 today, right? And you're planning on retiring in 7 years. So 150,000, toss in interest rate over the course of the next 7 years, so multiply that by an extra 25%. So that's about $187,000 that you will pay over the next 7 years. Well, 7 years, 12 months, 7 times 12, 84. So 187,000 divided by 84 would give you a rough number of, okay, I need to start putting about $2,200 a month on this debt in order to make sure that it is fully paid off before I retire. Now, again, much more accurate and sophisticated ways of calculating it using the internet. Look for an amortization calculator to really get that fine-tuned. But the reality is that that gives you at least a rule of thumb that you can use to really start that notion of trying to get rid of that debt on a regular basis. And it's a great timing, it's a great time to do that, particularly if you think about debt and the interest rate. Obviously, with interest rates as low as they are, you've got a great opportunity to try and refinance, maybe lock in a lower rate, maybe look at changing a 30-year mortgage to a 15-year mortgage, drop in interest rates, and that shorter period of time ultimately allows you to get that mortgage paid off over the course of a shorter period of time, and in particular before you retirement. Because remember, that interest rate, that just adds to the cost of what it is that you borrow. There's an ongoing cost that comes with that interest rate, that each and every year that interest rate applies on that principal amount that you borrow. Then the reality is that you've got additional amount of money that you must pay on it. So let's give it I would certainly encourage folks to sort of tackle that. You really don't want to go into retirement with that extra payment, because that ultimately means now you've got to deal with that, and that is a drag on your overall retirement plan. So go against the trend these days. That's a crazy trend, right? It's gone from 50% of those early retirees having debt as of 30 years ago to now over 70% of those retirees now have some form of debt. A significant increase over the course of the last few years, and the reality is that that's certainly something that folks want to lean into and deal with, rather than ultimately have a portion of that income each and every month in retirement having to go to debt service. So make sure you stay away from the trend of that debt being more present in folks that are retiring. So with that, we want to certainly take a moment and wish everybody a very happy Thanksgiving. Again, the statistics on frying turkeys, be careful, that we gave at the beginning of the program. Be careful with that if you're going to do that. Enjoy family, enjoy friends. I know at our house today, my oldest is coming in. My middle one came in yesterday. And so it's great to have all of the boys back under roof for at least a few days here at Thanksgiving. I think that's the best part of the holiday, is getting the crew back together. And so we hope that you and your family also have that opportunity to do that and have an enjoyable day as well. It looks like weather-wise it's supposed to be a little bit cooler this coming week as well. So almost like a little fall break here in Central Florida. So with that, we thank you for listening to the program. If you missed any part of the program, certainly want to give you an opportunity to subscribe to our podcast channels, because certainly the programs are all there. And if you're interested in any of the topics that we've talked about over the past several weeks, of course, we've got years and years of shows on those podcast channels. So I'm sure that there's something there of interest to you. So be sure to subscribe to us on those channels. With that, we will wrap it on up and get on out of here. Thanks for listening to the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.